All right, welcome back to another episode of Real Estate Without Borders. Today is one of our first guests. It's me, Dave Hutch, Daniel Foch, and Sami. We have an accountant here who owns two firms, one in Toronto, one in Florida, and we're going to be covering a lot about how Americans need to worry and structure their taxes when investing outside of the US. So I'm super excited because this is honestly probably one of the most questions we get asked. So we're going to try to cover as much as we can and keep it as simple as possible. I'm excited for this one. I think it's going to be good. Let's kind of jump into this, and let's start with, I know we were just talking about this before we hit record, and I wanted to get this on camera. So the Canadian tax implications. Okay, so Sami, you have offices. Well, first of all, maybe you should introduce yourself. Let's do that first before I jump into it. Sami, take it away, buddy.
Thanks, Dave. So yeah, I'm a licensed CPA of Ontario, Canada, and I'm also an IRS enrolled agent. So my practice has been around for 14 years, and we focus on cross-border tax between US and Canada, and we also do international tax. So thank you.
It's exactly what we need.
Yeah, so I guess what we really want to chat through today is like, what do people need to know if they're thinking about investing in a place outside, let's say outside of the country that they live in, and you can use, like, if you want to, probably the largest portion of the audience is going to be from the US. So if it's easiest to kind of use that as an example, go for it. But what like if I live in any country and I want to buy real estate in a different country, what are the key considerations that I need to think about?
Yeah, well, first off, so yeah, mainly our focus is between Americans buying Canadian real estate, but I can generalize to say that it's always very important, whatever country you reside in, if you're buying Canadian real estate, you always want to check what your domestic tax laws are. Usually your country will have some sort of income tax treaty with Canada. Canada has income tax treaties with a lot of countries around the world. So essentially, for an American who buys Canadian real estate, one big consideration is something called FATCA. It stands for Foreign Account Tax Compliance Act. So this came into place for basically Americans who have to report any offshore bank accounts. So essentially, obviously, when you buy real estate, you have to open up a bank account in that country. You're going to have at least the threshold, which is 10,000 USD at any time of the year. They're going to have to kind of report that back to the IRS. Other countries, UK or any other country around the world, they're going to have to check with their domestic tax laws on what their foreign reporting standards are.
Did you say so? The Americans that are looking to purchase in Canada, let's just say that for example, they need to have. They're going to have to open a Canadian account to complete that transaction. And did you say there needs to be at all times at least $10,000 in that account?
So that's the filing threshold. When you hit 10,000, you got to file something called FBAR. So the technical name is called FinCEN 114, but the layman term everyone calls it is FBAR. And so when you hit that threshold at any time during the year, a U.S. citizen has to consider the FBAR. There's also another form, part of the FATCA reporting, called 8938. That threshold is 50,000, but usually that doesn't get triggered when you buy Canadian real estate directly. It only gets triggered if you buy it through a foreign entity. So if you buy Canadian real estate through a Canadian corp, that will trigger Form 8938. So it's probably sometimes more tax advantageous to consider buying it directly as a U.S. citizen and not buying it through a corporation.
Okay, so it's beneficial for them to own and purchase as like a personal entity from the U.S. as a foreign buyer instead of trying to open up a corp in Canada and purchase that way, correct?
Correct. Because then they can avoid several forms. One is Form 8938. One is Form 5471, which is a disaster form to fill out for an American who buys any sort of entity for a foreign entity. You got to report basically the whole financial statements of that foreign company. It literally is a very, very complex form to fill out.
Okay, interesting. And then, so you said that, can you maybe, because explain it to me like you're drawing in a crayon with the $10,000 thing. Is that like, say you're buying an investment property in Canada as an American, the income that comes into that Canadian account, once that hits $10,000, that's when it would get triggered?
Correct. So any U.S. citizen or green card holder, if they have signing authority, they don't even have to own the account. Let's say you have a signing authority on any account outside the United States. As soon as it goes over 10,000 USD, so let's say it's like 10,000 Canadian, it won't get triggered. But if it goes to 10,000 USD, usually you got to convert the Canadian into USD. Then you got to file the FBAR.
Cool. Okay. Can you explain like the advantages? I remember we talked about this kind of briefly before off camera, like on the phone, but the advantage of buying as a American citizen versus buying in a corp. Just like what's like the main benefits for somebody, and why would they choose to buy as a citizen versus a corp? Other than that whole form, is that the main reason?
Very good question. Yeah. So that Form 5471 we were talking about, if they buy it through a foreign entity, it's gonna create such a disaster for them for their filing requirements, because then they got to re-report all the financial statements of the foreign entity on their U.S. tax return. So it's always kind of something to consider to have an American buy real estate in Canada directly or through some US LLC. Probably a US LLC would probably be something more advantageous. Now, one thing to consider that Canada doesn't have LLCs. So Canada doesn't see LLCs as flow-throughs. We only have personal, we have corporations, we have partnerships. So that's another thing to consider, that LLCs are, even though they're flow-throughs in the United States, in Canada, they're considered corporations. You might be subject to double taxation. You got to be a little careful with that as well.
On the taxation side of things, just because maybe I want to understand it, there is a tax treaty. I know we keep covering Canada, but there's a tax treaty between US and Canada, correct? So you wouldn't get double taxed, right?
Exactly. So for the most part, there's articles in the tax treaty between US and Canada that covers things to avoid you being double taxed. Now income tax treaties are not perfect, so sometimes you always got to check the articles in which the treaty relies on to see if you could take a treaty position on that double taxation.
Okay, because I'm just reading through your notes here. So that's covering like the foreign tax credit. The taxes paid in Canada can be credited against the U.S. taxes using Form 1116.
Yeah, good point. Yeah, Form 116. So essentially, as an American or anyone who has to file Canadian rental tax return, you're going to obviously pay Canadian taxes on the net rental. Luckily, good accountants can probably create losses on rental properties in the first few years. You got a lot of renovation, a lot of depreciation, a lot of mortgage interest. So technically, you're not going to have that big net income, but you never know. So if you do, and you do pay Canadian taxes, you can pop it over on the US side under Form 116 and then eliminate the double taxation. Now, I'm in Florida. So Florida's a state that doesn't have state income tax, so you only got to worry about the federal. So really, you're flying. So once you pay the Canadian taxes, our tax rate's a lot lower than Canada. We're not going to pay any tax in the United States on that rental.
Cool. I think Foch, you want to cover the capital gains? I know I skipped over that. I got excited about Form 1116. Sorry about that.
Yeah, I guess we could do that. The one other thing before we actually jump into capital gains, is there any limitations on a state by state basis? So like a lot of the people looking to invest in real estate in Canada, as an example, are coming from California. I actually had somebody ask me recently, and he was under the impression that like California was one of the only places that there was complications to the tax treaty. Is that the case, or is it the same for every state?
So from what I know, I think the income tax treaty is on a federal level. It's on a national level between Canada and the United States. Each state has its own rules when it comes to state tax filings. So probably unaware on a state by state basis, but it could open up some tax issues on the state tax return. But usually you get an adjustment for any federal sourced. So international source funds don't go to the state. They get usually deducted, but each state has its own set of rules.
Okay, awesome. Yeah, I think that their concern was that that California didn't recognize foreign tax residency, but I'm not sure. Maybe we can cover it on a subsequent discussion about this. In regards to capital gains, because I know that there's some differences that need to be considered regarding capital gains in Canada versus the US. Or in many other countries. I mean, a lot of countries don't have capital gains. A lot of countries have far larger capital gains. How does that get taxed? Like, everything that you mentioned so far is kind of on income tax on a rental. What does it look like when somebody chooses to dispose of something and they're subject to paying a capital gain? How does that get taxed when that capital ends up coming back into the US?
Very good question. So capital gains are very similar in the US as they are in Canada. And we also got a principal exemption rule similar to Canada, where if it's a principal residence, you don't pay tax. Here in the United States, we have it, but there's an exemption amount where for a single person, they don't pay tax on the first 250. That's 2K. And then for a married person, it's $500,000. So essentially on an investment property, you don't get those exemptions. So you sell the property in Canada, you pay that income tax. We're going to go back to what Dave mentioned about the Form 1116. You're going to claim that tax credit and you're going to eliminate the double taxation on that.
Interesting. So in that regard, it just becomes like it becomes an income, let's call it, and then you use the same filing procedure that you mentioned
strategy
before. Cool.
Same,
okay,
yeah,
cool.
Same strategy. Ideally, you don't want to pay capital gains tax twice, so you're gonna hit it with the foreign tax credit.
Okay. And then does the FIRPTA apply to foreign property ownership? Like, would it trigger that where non-residents are selling U.S. real estate?
Good question. No, so that FERPTA tax does not apply to U.S. citizens or green card holders buying foreign properties. That's actually for non-resident or non-U.S. citizens or non-resident aliens buying U.S. properties and selling them. So FERPTA does not apply to Americans buying international real estate.
If you guys think you're going to get away with not telling me what FERPTA means, that's criminal. Let's back that up and cover what FERPTA means, please, in crayon.
Yeah. So I'm one for acronyms, so I barely ever use the full thing, but I'll go ahead and tell you it stands for Foreign Investment in Real Property Tax Act. But we always go by the acronym FERPTA. So, it's just an act for basically non-U.S. citizens or non-green card holders. When, like, let's say a Canadian, he buys a property here in Florida. You know, they're a snowbird. They own the property for a few years, and then they decide to leave and sell the property. Well, guess what? They're going to be hit with this large withholding tax, 25% of the gross sale. So if the property is $1 million, right off the bat, the IRS is holding $250,000.
Interesting.
Now, that's not their final tax liability. When they go to file their tax return, their final tax liability might be like $75K. So they're going to get this massive refund. What we do, we're acceptance agents. So we can actually help them get a withholding certificate to reduce that withholding amount to what their actual liability is. So we do the FERPTA tax withholding, and we also help Canadian snowbirds who are going to sell U.S. property to reduce that.
Cool. On that note, well, first, Foch, are you crushing energy drinks over there, or what was that?
No, that was a Poppy.
Don't lie.
You ever had Poppy? You know those, right?
I do know
Probiotic,
those.
like fake soda. Oh, dude, I live off these things.
This guy is health.
They got those at Whole Foods.
Yeah, everywhere. Like they just came to Canada, so they got them Costco here, which is pretty nice.
They're not in Mexico yet, fellas. So I'm still drinking
tequila.
Bubblies. Yeah, tequila.
You got tequila, dude. You got the Don.
That's right. I go right to the source.
That's a health food beverage. No.
That's right.
Yeah, it's very healthy, man. Agave.
Hey, before we go, I wanted to quickly the exchange rate considerations, because if an American is buying in Canada, or I guess anywhere globally, actually, for capital gains, would the capital gains and rental income be reported in the currency that the country that they bought the property in, or would it be reported in US dollars?
Very good question, Dave. For an American reporting that Canadian rental income on their tax return, they gotta use the IRS Treasury rate. So if you go into Google literally and type in IRS exchange rates, they'll pop up the exchange rates for a bunch of like major countries. Canada's going to be right on there. It's going to have different columns, and it's going to give you the year that it applies to. So for like 2023, 2024, they'll have the exchange rate. You're going to use the IRS rate, use the annual average, and convert all the income and expenses to USD.
Crazy. I'm on Twitter. Just Sammy, if you ever need some answers, check out Twitter. Okay, Twitter's got this AI called Grok, which I've spoken about this in the past. I just want to make sure you're aware of it too.
Dave's sponsored by Grok, actually.
Dude, I need to get Elon Musk on the show to get me a sponsorship for Grok, because anyway, it's the best AI platform. Anyways, neither here nor there. Super cool. Okay, I'm going to Google that on my own time. Foch, what do you got next here lined up?
I think like what would be in your experience where people are buying the most real estate from the US, like so where are US residents buying the most real estate, and what are like kind of the oddities of those countries? You know, Canada probably being a big one. I think Canada and Mexico are the two biggest places where Americans buy real estate. So we could maybe start with those. What do people need to know if you're a US investor buying property in Canada or Mexico or anywhere? Like are there any standardized kind of, I don't know, weird things that you think to watch out for?
Yeah, I mean, from an overall perspective, I've had Canadians buy. Sorry, can you hear me? I think one of my
Oh,
AirPods
you're good.
went out.
No, you're
Okay.
perfect.
Yeah, so I've seen issues where, you're buying properties and partnerships, and some partners want to exit early, so it creates some kind of dysfunction. That's more on the business side of things. I've seen people approach me for. I'm gonna have to pop in. These both died. Give me 1 sec. Sorry.
Yeah, no sweat. Take your time. No. Let's get Poppy on the show as a sponsor, Foch. What do you think about that?
I'm down.
What's
Yeah,
the
let's
flavor?
try.
What
This one's
flavor?
orange, but they got
Orange, eh?
there's
Is it
another
on
one,
sale?
Cove as well. Well, Costco, like they're cheap. I don't know. They're if you go just buy them like retail, they're like $3 a can. It's insane. Might as well drink energy drinks and you get jacked up for the day, but same cost, right? But
That's right.
man, not,
I'm one of those health nuts too. I actually prefer wired headphones, man. I'm one of those like conspiracy. I think the brain waves
yeah,
cook. You get cooked eventually, right? So it's like
yeah,
you gotta go to the wired. So
That's
yeah.
right.
as
I'm
I
already
was
cooked
saying,
enough actually, so it's my whole
Mine are
life doing it. My DIY solution. I didn't need headphones to do it for me.
do it yourself. Yeah, I know. The last 20 minutes of tax will cook you too. So, but essentially, as we were saying, yeah, I've seen a lot of fallouts where people buy. Like I saw, I had a client in Canada. She bought a property in Tulum with two people, and one of them needed to get liquid. It created a huge issue. Getting over the border mortgages, it's sometimes challenging. Dave, I know you know a
yeah.
lot about that, so you could talk on that. But essentially, for an American, whether he buys property in Canada or Mexico or anywhere in the world, there's an interesting thing about it where on Canada, we don't really have this, but when you go to buy that rental property from day one, you gotta separate. Like, let's say it's a house and there's a plot of land. Bless you. There's a plot of land. Bless you again. I know there's allergies right now going on. Well, where I am, but so essentially you got to like separate out the land from the real estate. Like, let's say you buy a property for $1 million, and there's a land component. You can't depreciate $1 million because land's not depreciated. Land doesn't break down. Land doesn't tear down. So you gotta, your accountant, he has to think about separating the land out just to depreciate the building, because the IRS looks at that on your depreciation schedule. So that's one thing that's like an interesting thing that you wouldn't really see unless you're an accountant. But you got to always separate the land components.
I wonder, like, one thing that I experience a lot for Canadians and Americans investing in Mexico specifically is the tax here is significantly less in Mexico. But what they try to do is, I don't know if I'm talking to the wrong guy here with the IRS, but what they try to do is keep the US and the IRS maybe out of the loop by keeping money in Mexico and not bringing that money back to the US. Is that something that people kind of ask you about? How can they shelter or maybe utilize, and I'm not trying to catch you off guard because I know you don't do like the global accounting, obviously, but if let's say, for example, I buy a property in Mexico as an American, and I'd rather take advantage of the low tax rates in Mexico versus America, is it possible to kind of shelter that income, or is that illegal?
Good question. I mean, it's illegal. I'll tell you a cool thing. Like, we're all Canadians, right? So
That's right.
we're just used to like only having to report income when you're a resident in Canada. When you terminate residency with Canada, it's like you don't owe Canada anything because you're
Right.
not a resident. But the thing about the United States, it operates on a citizenship and a green card holder and a resident type of status. So I can be living in freaking Antarctica, but if I'm a U.S. citizen, I mean, I used Antarctica, I don't know why, but if I live in Antarctica and I'm a U.S. citizen,
Don't do that. Not
even
financial advice.
yeah, yeah, I'm not giving you good advice here. But if you live there, you got to report any income you earn anywhere in the world, even if you don't live in the United States, if you're a U.S. citizen. So if you're a U.S. citizen, you got that rental income in Mexico coming in, you got to report it on Schedule E. So there's no way to really avoid it. Now, do you have to pay tax on it? That's another question. We talked about eliminating net income through depreciation, mortgage interest, all these expenses, renovations. So you might have to report it, but you're not going to have to pay tax if you don't have net income.
Right, if you do it. So that's why we wanted you on the show, Sammy, because I think that's important to understand. It's like there's the right way to do this, and you can do it successfully if you have the right people in your corner, doing things by following the rules. If there's anyone else in the IRS is listening to this, don't come for me. I'm just asking questions here. I pay tax everywhere on time.
There you go.
Just making sure.
Register that name, Dave.
That's right. Okay. So I want to talk about just quickly tax treaties. What is that? Can you explain what a tax treaty is? What's the tax treaty between U.S. and Canada?
So in Canada, we have our Income Tax Act. In the United States, we have our IRS code. So a treaty, sometimes these separate tax laws don't intertwine, and they don't help people that have cross-border tax complications. So they come out with a treaty. The whole point of this treaty is it's like overriding the domestic tax laws of each country to kind of try to offset this double taxation issue that these people that have issues on both sides of the border. So that's what, I mean, in my layman's terms, that's how I guess if I use a Wikipedia or whatever, it might give you a different definition, but that's my definition of it.
I like it.
Yeah.
Foch, you want to, the one thing that in the notes, because I'm reading through everything we were kind of talking about, and it's like, to avoid triggering Form 5471, extensive reporting requirements, try to purchase Canadian real estate either personally. Oh, we spoke about that. Okay, so by purchasing personally, you avoid that 5471 form. Got it.
Yeah, you avoid that nightmare of a form, man. If you've seen
Why is it a nightmare?
It's a nightmare because, okay, you ever seen a corporate tax return?
I've heard the U.S. are crazy, yeah.
So you got, in Canada, you got the PREC.
Right.
You use a PREC? Okay.
Yeah.
So you know that whole T2 you got to fill out, right?
Yeah, of course.
Now, if you're an American that owns a Canadian corporation, so you got to go file 5471. You got to go take that tax return in Canada, translate it to USD, and re-report it under your personal tax return in the United States. It's a nightmare.
Oof.
So then you're subject to repatriation tax on your retained earnings, and you can thank Trump on his last term for coming out with that. He wanted to make America great again by bringing businesses back into the United States. He didn't want Americans owning offshore corps. So that was his motivation to do that.
Interesting. Okay. Do you want me to, I was going to cover the documentation that investors should maintain for tax purposes, unless Foch, you had something you wanted to jump in first, or is that good?
Go ahead. Yeah.
Okay. So for an average investor, or maybe someone that's investing globally for the first time, what are some documentation that they should make sure they hold on to for tax purposes? That way they're not scrambling when it's time to file taxes. Yeah,
good question. So in the US, we have a HUD where, if you use a title company to close, so our Canadian equivalent is the purchase and sale agreement.
Right.
So we need the purchase and sale. We're going to need if they're using a Canadian mortgage to purchase the property, we're going to need their year-end mortgage statement that shows all the interest they paid. We're going to need their property tax bill for the year. We're going to have to claim property taxes. Maintenance fees, if it's a condo. If it's a house, they obviously have let's say they've got lawn care or snow removal. So you're going to need basically all your expenses, and hey, don't forget your rent roll, right? You need your income.
Right.
So you got to see what you've collected in terms of income. Now, the interesting thing about the U.S. is we're on a 1040 personal tax return in the U.S. You're on a cash basis. In Canada, you work usually on an accrual basis. So cash basis means we're only paying tax in America on money we actually collect. Yeah.
Okay. So if go on. Sorry.
Yeah. Go ahead.
No. I don't. No. You're smarter. Keep going.
So if the lease starts in December 15th, but the 1 month hasn't accrued, so in Canada you would report it because you're accrued 15 days, but in the United States you wouldn't, because you haven't received the rent you haven't received the rent from the tenant yet until the end of the month.
Okay,
So
interesting.
technicalities there, little technicalities.
I think the last thing, maybe unless Foch, you got some more stuff, but the last thing I want to touch on, because it's from our notes, which I think is actually super important, is like investors, how can American investors optimize their tax position with like rental income or the sales proceeds from foreign investments? So it's like, I know the one part you mentioned here is that, you know, when you're remembering to file, this is your language, not mine, Section 216, which allows you to tax net rental versus gross.
Correct. They could take the election, file that Section 216 form with Canada, and then ideally you're going to be taxed on the net rental. So as I said, we're going to try and create that loss on your rental property. Well, you can't create a loss, but you can offset it to zero. Once you offset it to zero, guess what your tax is? Dave, you could probably answer this.
What, zero? You caught me off guard.
Zero. There you go. Zero. No, you got it right. That's the right answer. So
you guys hiring over there? I'm ready.
Yeah, man. We need people. Me and
That's
Mebby are getting crushed out here at tax season. So
I bet.
We can use your help.
All right, Foch, do you have any other questions?
Yeah, I guess like the only other thing that I think is worth talking about for U.S. investors buying outside of the U.S. is you're starting to see like this nationalistic sentiment happening with like a lot of countries that have been recipients of remote workers and like the COVID exodus and whatever. Portugal has now put in like a foreign buyers ban, or like they've kind of scaled back their golden visa. Spain has increased their land transfer tax for non-residents. Canada has the non-residents speculation tax in Ontario, or a foreign buyers ban.
Tax.
Yeah, foreign buyers ban now. What's your perspective on like what do people need to know in that regard? And are there any ways to kind of like work around? I know in Canada there's a couple of ways, like people can buy outside of CMAs, or they can buy buildings with more than 4 units in it. But are there, like, from your perspective, are there any ways to continue investing in real estate in some of those countries where policy has tried to make it difficult to do that?
Yeah, in terms of finding loopholes, I'm not aware of any where you could avoid this speculation or foreign buyer tax. Technically, yeah, I've seen it really affect our real estate market, because a lot of wealthy investors internationally were pushing demand, which basically pushed down supply and increased prices. Now, when they come out with these taxes and try and ban foreign investors, what's that going to do to the real estate prices? It's going to obviously push them down. The rent that's requested is going to be different. So it's going to impact us overall. But as of now, I don't know any sort of loopholes to kind of avoid that. I do know people who like end up moving. They were non-residents. They moved to Canada. They're not technically a foreign person. So that in regards is a way to avoid it. Daniel, do you know anybody, or do you know any methods to avoid that yourself?
Just that, like, just buying commercial properties. So I think foreign investors can purchase up to 10% in a corporation. Like, so if they're not the major beneficial owner of a corp, they could buy a property that has more than 4 units and technically is commercial, for more than 4 residential units, or they could buy outside of a census metropolitan area, so more of a rural property, to do it. There are go ahead.
So not subject on the commercial side of things, I guess.
No, yeah, it's not. That would have blown up the whole industry, because I mean, a lot of our development land. Initially, the policy was actually worded in such that was the case, and then they had to make some changes for it, because basically a lot of foreign capital buys development land in Canada, and there's a lot of foreign developers, and it made it impossible for them to do that, right? So. And not just that, but like a lot of the buyers of office buildings or whatever. There's a lot of
vacancies shot up too after COVID. With, I know a lot of commercial landlords took a hit because some people just went totally remote after.
For sure.
So, but that's more for office, I guess.
Yeah. I think it seems to be coming back. Like Toronto's actually got the strongest return to office in North America. Like 72% of pre-COVID now, but I think it's just awesome. We'll see what happens. I don't know. The future of the office is a big question mark from my perspective.
I agree.
Okay. I think that's everything. I learned a lot from this. I really appreciate your insight and expertise, and would love to have you back on the show maybe when we have some more pointed questions from our audience on what they're looking to do and kind of the things problems that they're looking to solve.
Sounds good. Thank you for having me, Dave and Daniel. You guys are great hosts, and appreciate it as well.
Yeah, thanks, man. Appreciate your time. Take care.
Bye-bye.